on site with my good friend Arthur Hood. What's happening, Arthur?
Not a lot. Good morning.
I appreciate you going to the extreme trouble that you've gone to create this opportunity for you and I to speak to one another.
That was easy.
It was easy.
I already have the office, so.
You know, we got the space, we've got the opportunity, and we definitely have the topic today. But Arthur, before we get into the topic, I want to frame the conversation for you around this avatar that we've created named Stuart. Stuart is a character that we dreamt up to represent the investors that are most likely watching this program today. And most of them listening have built some wealth in the stock market, but they've got capital gains. They definitely have tax exposure. And they're starting to ask a very basic, simple, but incredibly important question. Where does my money go next? So today we're going to explore an asset class that you are just an absolute expert at. And it's quietly outperformed like almost every other real estate sector for decades. It's self-storage. So Arthur, man, like you've structured more money in these kinds of transactions than I can even keep track of. You keep a running total of?
I started to look at it one day. I think just over, between lifetime of transactions, probably just over $1 billion.
There you go. There you have it. So we'll just clarify that was a B. Billion.
Just over $1 billion.
Not million. So
yeah,
that's
over
important to
various
understand.
Industries, but yes.
So let me just ask you, like, so we said, right, like this group of people, they're sitting on a stack of RSUs, right? They've got the opportunity really to create some leverage from the income that they've created that's largely sitting dormant. So in the capital shift, what we talk about a lot is this idea of needing to change the way you think so that you can change the way that you invest. So from your perspective, when people are starting to explore real estate as an investment vehicle, like what's the first big mental shift that they need to make?
The first big mental shift anyone needs to make, especially switching to a real estate investment, is that it's not a true liquid investment. There is a somewhat of a cost to get in, cost to get out as far as selling a property, buying a property. But long term, you're going to get depreciation, the ability to use leverage, which you really can't use in the stock market unless we get into leverage and a bunch of high risk involved in that.
Right.
So you can do those items. Is the biggest shift is if you've got $1 million in stocks, if you want $1 million in cash, you can have $1 million in cash the next day, wired to your bank account by day 2. You can't really do that with real estate. However, you can still get liquidity, but you have to borrow against your real estate. But then that's a tax-free transaction.
And that, ladies and gentlemen, is what many of you are after. So if that catches your attention, you're going to want to pay close attention to the rest of what we're going to talk about today. So a lot of times, Arthur, Stuart, as a character, he's got a mental construct that he needs to break down before he or she can really make this change that you're describing. So what do you think is the one big belief that investors are stuck with that keeps them rooted in the stock market and really not considering what we're talking about?
I think one of the things that keeps people rooted in the stock market is just the ease. It's a click of a button. They don't have to think or do anything. Real estate seems complicated from the outside if you've never done it before. However, for me, I'm a lot more comfortable with real estate. It's a hard asset. I can touch it. I can feel it. Regardless of what happens to the U.S. dollar, it will be paid for in some form or some currency. So if the dollar was to ever just crash and burn, real estate will trade in some form of a currency, gold, it doesn't matter, but it'll maintain its value.
Amen. And if you haven't given consideration to that thought, there's a foundational aspect for you to really spend some time thinking about putting into your favorite AI engine to really spend some time in self-discovery around what this process might look like for you. But there's definitely something to be had when it comes to this. All right. So myth is busted. But let's talk about the actual asset class of self-storage itself, because I've watched some of your other content. You have some really interesting perspectives on self-storage as an asset class. So when the watcher first hears self-storage, for me, I can remember when we first were considering this asset class when you were talking about it, and we kind of wrote it off. It's like, Why would that be an interesting or valuable asset class? So for your perspective, like, why does that reaction cause people to miss that opportunity?
I think a lot of it's because when people think of self-storage, they think of the old roll-up door, makeshift building on the side of the highway in a small town, 20 miles from where they live. They don't really see the new Generation 5 climate-controlled facilities that look like a medical warehouse. They're beautiful. They're done very well. Concrete floors, stainless steel in the walls. Everything's climate-controlled. And they also don't realize, if you live in an older home, you probably have a fair amount of closet space and some attic space. But if you live in a newer home or an apartment, the builders were never really incentivized to provide a lot of space they weren't going to get a premium for. So there really isn't that much storage in a lot of new places, and people in their 30s and 40s and younger and older all have hobbies, whether it's hiking, kayaking, skiing, working out, whatever, bike riding. So everybody has things that they don't have room to store at home anymore, especially if they live in an apartment or a smaller starter home. They've got to have somewhere to store their stuff.
Absolutely. And what we've noticed is home ownership from first-time home buyers, it's taking them longer and longer and longer to actually be able to buy their first home. So they've got some more disposable income in many instances because they haven't necessarily found themselves pressured into saving for a down payment, just purely out of belief that they're not going to be able to be a homeowner. Secondarily, we're starting to see a lot of build directly to rent product that's hitting the marketplace, which is just going to be a continuation of what you're talking about as far as the builders not really being incentivized to create storage space for the people who are moving into that product.
Absolutely. A lot of your build to rent product doesn't have much storage in it, but you've also got a lot of younger people who are wanting to remain transit. They're not buying a property. Maybe I agree, maybe I don't with that. I think they should, but they're renting for a lot longer period, staying in a smaller place, and they all have things that have to be stored. And also, I've seen accumulation of they were in a little bit larger place, and they're going to store the sofa and the TV and this, that, and the other, and the bike and the workout machine, and they end up storing it for 5 years.
For 5 years. So let's dive into this a little bit more. So if Stuart's sitting there right now on, let's just call it $500,000, why would storage be more interesting to them maybe than a traditional long-term rental, multifamily, or even a short-term rental approach?
Well, I think depending on your goal, I'm involved in all of the spaces. I have a significant portfolio of single-family rentals. I'm involved in some multifamilies. I'm involved in one industrial complex. I'm involved in some retail. But what I like about storage, and we put a decent amount of that money in storage, is what we're doing is ground up storage. So we're buying property that is pre-entitlement. We're putting it under contract, entitling the property, and then by the time we purchase the property, there's been a value lift between unentitled and entitled property. So, we're just making up numbers here, but let's say the unentitled raw value of the property was $1 million, but by the time we have it entitled, it's worth $2.5 million. Then we're going to build something on that for maybe an additional 15 million or 20 million. So maybe we're all in the deal for 20 million. Well, it's going to be worth, it's stabilized. It's going to be worth 35 or 40 million, maybe more, especially as you start to push up rent. So your value lift of going into a new construction deal is significant because you're going to get the lift of value and not just the appreciation, but the completed product appreciation. Also, I think that the thing I like about storage is you have a diversity of tenants, because you're going to have, in a lot of these projects, you're going to have 700, 1,000, 1,200 units. So if once you get it leased up, which takes a couple of years, but once it's leased up, if you lose a few tenants, who cares? It's spread across a long piece. Also, you're not having to go through a complicated eviction process. Depending on the state, you lock them out, send a demand, they don't pay. You can auction off the stuff, which hopefully will return most of the unpaid rent. Generally does. Most of it will be returned. Then you can sweep the damn thing out and re-rent it. There's not any, there's no tenant improvement. You're not having to do a bunch of tenant improvement to get somebody in like in a commercial space. Mm-hmm. You're not having to do paint and carpet like in a residential apartment. and you're not having to pay leasing commissions to get somebody else in.
Right.
So all of those things make for a faster turn.
With less cost of goods, really.
Correct.
In a lot of ways, because the eviction process alone for a long-term rental, again, depending on where your property is, a year sometimes before you can get a tenant out. And you're saying
in certain states, you can probably get somebody out in 60 days, but that's becoming rare. And in other states, sections of Washington State and California, you could be 6 months to a year or longer to get a tenant out. You've got some states that have passed laws you can't evict during certain temperature, cold weather, and all these types of things. Not arguing whether right, wrong, or indifferent, but it's just a fact you have to deal with if you own rentals in those markets, especially the long-term rentals in those markets, where in the storage they don't pay. Sweep the fucking thing out, open it up, auction it off, you're done.
And life is
good.
The
real process would be lock them out, send the demand, auction it, get your money from the auction. Hopefully it covers your past due, sweep it out, and re-rent it. You're not having leasing commissions or anything else.
Easy
no
peasy.
Paint, no carpet.
Easy peasy. Well, let's back up, because you touched on a topic that I think stewards out there would be really interested in hearing more about. So when you're talking about ground up, you're talking about we're going to take a raw piece of land, and when it's done, it's going to have this beautiful, brand new climate-controlled self-storage facility sitting on it. But in that process, you've taught that there's opportunity actually to create appreciation and value in that property along the way. That's called the entitlements that you mentioned. You want to just elaborate on that for the listener a little bit?
Yeah, being in the real estate development business, to me, entitlement's fairly simple, but for most people who've never dealt with it. So I buy raw tracts of property, or generally I contract raw tracts of property, both for storage development, but I also do subdivisions and entitlement. I sold 300 and a little over 300 acres, 600 lots, a little over a year ago to D.R. Horton. But I'll assemble several properties or one property that is just raw land. Then I will get the zoning, which is basically entitlement. I'll get the zoning changed or get it approved for whatever I want to put on it, whether it's storage or whatever. Now, there's regulations and what you can and can't do, but I find a better use for that property, and then we'll get it entitled. So in other words, we get the project approved. Once we get the project approved, that's a value lift in the raw dirt. Now, you spend a little money to do that, having it under contract, legal, engineering, architecture, et cetera, but then you have a fully approved project entitled. Then we go all the way through design phase. So not only have we got it approved, now we have a design for that particular property that is now approved. And by the time we're ready to pull a building permit, like I said, you could have a significant value lift. A $1 million piece of dirt could be worth 2 or 3 million or 3.5 million. Just all depends on what you've done, and what the end economic looks like. Because it's raw dirt, it's raw dirt. Once it's entitled and proved under a full design that's engineered, now the land value is a part of the completed project value.
You built equity along the way, and there's actually other guideposts along the way that also create additional value in the property as well. You want to just touch on those real quick?
Well, there's a lot of guideposts that could, different things that create value on. And if you're talking about self-storage, once it's built, you've got the revenue for the self-storage, you've got the insurance revenue. We get a split on the insurance for the individual tenant that has insurance on their stuff. We split that revenue. So there's that. We have some of our projects end up with some billboards on them. We have one in Las Vegas that's going to wind up with a billboard that's going to add about $2.5 million of value, because we have advertising revenue off the billboard to the highway that it's located next to it. So there's lots of value adds on property. I've taken raw property and carved off 200 lots and sold to a home builder, and then kept a commercial piece on the front that became a little strip center. Mm-hmm. There's all types of value adds that create equity on property once you come up with an idea, get that idea approved.
So it seems to me as though, as in just about every other asset class in real estate, there is a heavy emphasis on location. So how much of this equation is predicated on making a smart choice on where you're putting it, And how do you approach that particular part of the equation?
We have a really, really good team. My partner in the storage development business, Russ Colvin, has a track record and a history through developing two other storage companies that both were sold and exited in picking really good locations. We probably look at 100 locations come across our desk. We take a serious look at 10 and wind up doing one or two out of that piece because it has to be in a market that is underserved. We won't go in an oversaturated market, which there are some. There's a lot of markets that are underserved. So we go into an underserved market. We make sure there's enough rooftops and apartments in the area and enough population count to be worth it. And then we look at market rents in that area. There are areas where have plenty of population, but for whatever reason, the market rents aren't as high as somewhere else. We tend to also focus in on areas. Now we have built in Texas, which is fairly easy to get approved, but a lot of our projects are in areas and municipalities that are very difficult to get storage approved. It may take us, 2-3 years to get a project approved, sometimes a little bit longer. However, you're not going to have competition next door because nobody else is going to go through that. They're going to go to the easier places. So we try to focus on the places that are a little harder to get approved because you'll have less competition.
Amen. I believe that's called, for the people who've read it, the blue ocean strategy, as opposed to the red ocean where there's lots of competition. So could it potentially be the case that two investors making an investment in a self-storage project could end up making different amounts of money?
Well, it depends. Percentage-wise should be the same if they're in the same project. Different projects are obviously going to have different economics.
Sure.
So one project could be a 39% IRR with a 3x multiple on the equity. One project could be a 20-something percent IRR with a 2x on the equity, and a project could be a home run, everything hit perfect, and you'd be a 3.5 or 4 times on the equity. It can be all over the place, but there's significantly decent performance. And everything we do, we pay a 10% pref to the investor. Now, it accrues during construction and it accrues during lease up and stabilization, but we do pay out a 10 pref that accrues that then pays out before there's a waterfall distribution to the GPLP.
Yeah. So really what we're talking about is velocity of capital return here, which I think is an interesting topic for an investor in this space. People have a tendency to want their money quickly. And when you're intuitively, if you think about it, we're talking about something that's going to take a period of time for it to be able to go from the identification of the piece of dirt that you might want to build it onto until it's all leased up and stabilized. So knowing that, is there any kind of secrets or thoughts around that process that you think would be valuable here?
The process can take a little while. So if you're in from the time you contract a piece of dirt to have it fully entitled, depending on the area, could be 3 months to a year. Right. And by the time you have something designed, approved, engineered with building permits, could be another 6 months. So you could be, from the time you've contracted a property to the time you start construction, could be 1 to 2 years. Sometimes you can do it a lot faster in certain areas, certain municipalities you can't. But once that construction starts, so let's take that off the table, but once construction starts, we're generally building in 12 to 16 months. We use Arco Murray, a pretty substantial contractor in the country, and they build quite quickly. We may pay a small premium for it, but the time savings and the guaranteed completion's worth it. From the time they start, we're 12 to 16 months to completion, and so far closer to the 12. And then you're looking at 12 to 24 months in lease up. You're probably fully leased at 24, but you're ramping up the whole time. So you've got a 3-year period before you're stabilized with a lot of cash flow. And then, of course, you're going to push those rents up. Our general time to exit from the time we put a shovel in the ground to the time we're going to exit is going to be about 5 years.
So what would an exit look like?
It could be a sale, traditional sale. It could be, if everybody wanted to, and we had a portfolio together, it could be roll it into a REIT, which is, by the way, everybody would then get shares in the public REIT, which is a non-taxable transaction. And now you have what people are used to in a public company. Now you have stock in a REIT that you can margin or borrow against. So if you had $1 million in stock in a REIT, you can borrow up to half of that, greater depending on your, not that I would suggest doing that, but you have a liquid asset that you can borrow against or sell off in small amounts. But generally, we would liquidate to family offices, private equity, or to Public Storage, Extra Space, CubeSmart, one of the big public REITs, or do a REIT transaction where we take stock instead of cash. There's multiple exits depending on what we're looking at the time.
All right, so let's try to break it down into something that somebody could use like as a timeline. So from a velocity of capital return, I make my $100,000 investment with you. What can I expect that waterfall to look like from a timeline perspective?
You'll start getting some checks in about, depending on where you come in the stage. Now, if you're in pre-land closing, which is a little bit different deal, but let's take that off the table. Let's just say you're in from the time we've closed on the property through completion. Sometime around month 24, you'll start seeing your pref paid out, and then you start getting distributions growing from there. So you're going to have a 2-year period, but it's a development deal.
Right.
That's why you're getting the return you're getting is
right.
You're sitting for a little while.
Well, and not only are you sitting for a little while, but there's a potential huge return at the end that is enticing. And it's important that people understand.
And there's also a point where, depending on the deal and depending on interest rates, so there's a lot of ifs in this. You know, if this was 3 years ago, I would say, well, as soon as it's completed, we'll refinance it with 4% money and return 50 to 100% of everybody's equity, and we just run it on debt. With interest rates where they are right now, that's not going to happen. But there is going to be an opportunity at some point before sale to refinance and return a significant portion of the equity. Now, you still have your ownership, but you've got a portion of your cash back plus your pref.
Right. Which,
now that's interest rate dependent. So.
Of course. But as is the case with most investment relationships, if you're loving the asset class, there's a good likelihood that the person that you're investing with has probably got a new opportunity for you to just continue that capital growth based on what transpired in the first transaction and whatever the prospectus in the second transaction might look like.
Correct.
Yeah, which is incredibly awesome. All right, so how does it go wrong, Arthur? Like, everybody's like, this sounds great, but like, what happens when it falls apart?
Well, you know, the real estate index shows that self-storage has the lowest default rate, commercial mortgage default rate of anything. Very few self-storages go wrong unless they're built in an oversupplied market. And even then, they're probably going to just break even. You know, the idea of total loss of capital on any real estate transaction done well is relatively low if you do your due diligence on the front side. You just want to make sure the equity value stays at least consistent with the total capital stack. That's debt and equity.
And to me, you won't say it, but we all know it. The operator is important. And I want to talk about this with you because you can see through operators who aren't who people should be investing in. So how can I, Stuart, anyone as an investor, like what are some of the signals that we're looking for that would signal go versus no go?
Look for operators that have had their nose bloodied at least once, that have been through an ups and a down. You know, one of the things that we've seen in the real estate market really in the last 8 to 10 years, the last 18 months is different. But prior to that, you didn't have to be that damn smart. You could fog a mirror, and whether you were rehabbing houses, flipping properties, whatever you were doing, you didn't really have to be right because property was appreciating so fast it would cover your mistakes. You know, there was a period 2020, 2021, 22 in that range where you could buy something, you could be over your budget on the rehab, but the appreciation was fast enough that it covered it.
Sure.
And you had such good spreads that you could have 12, 14, 18% hard money loans, and then what you couldn't put in a hard money loan, you could put on your 23% credit card, and it all washed out. Right now, you can't do that. You can still use hard money for the acquisition, but you're going to have equity, significant equity. Also, you had 5 people bidding to buy a house as soon as you were done with the rehab. You don't have that now. You may sit with something on the market for 3 months, 6 months, who knows? it will sell. There doesn't seem to be a lot of price drops. There's some, but they're not significant. But you need to have somebody that's seen all markets because, like I said, for 10 years, regardless of sector of real estate, if you were an idiot, you were going to make some money.
If we could boil it down to one question that the potential investor could ask that operator, what would be that one question you'd want them to ask?
I think it's actually probably two questions.
All right,
one of
that's
them is,
fair. Bonus question.
Have you ever had, what's your worst deal?
Uh-huh.
And how did you rectify that deal? So part two of that question.
Gotcha.
And that answer could be, dumped it. We all took a little bit of a loss, but we rolled into something else and rebuilt our money. Or we refied it, we held on to it for 15 years until it turned around. Depending on the deal, either could be the right answer.
What's a wrong answer?
That they've never had a bad deal.
Yeah, exactly. No, nothing's ever gone wrong.
and that could be very true for somebody that's only been in it a short time.
Yep.
That's not going to be true for somebody that's been in it 10, 15, 20 years. You will have something happen.
Yeah. So really what we're speaking to is that we'll speak to the tenure of the operator.
Yeah, the operator needs to be around a while. And it doesn't mean you can't do a deal with somebody new, but then you need to have already done a few deals and understand them yourself.
Yeah. All right. Well, so Stuart's excited. I can feel it right through the camera. Stuart's super excited, thinking about evaluating a deal here. What would be like the 2 or 3 most important things in that evaluation? And then what are a couple things that people would probably think were important, but really weren't all that important?
One thing that people think is very important is initial lease-up rate. It's really not that important, not in storage, because you may have something that 5 years out perform as $2.5, even $3 a square foot, depending on the market. So you may have something that in 5 years will be $2.50 a square foot on the rental. It may rent at 70 to 90 cents initially, the first 10% to get people in. Mm-hmm. Then it may rent at 95 cents to $1.10 until it gets to 50%. Then it may go to $1.50 from 50 to 75, and then from 75% occupancy, you ratchet it up again. But then once it's fully, full, 90% or better, your rents are all over the place. Well, then you're going to start pushing everybody's rents up. People generally do not move their stuff out. So every 90 days or 6 months, you're going to push their rents up so that you hit that pro forma number that you planned on 3 or 4 years out. It just takes a while to get there. A lot of people will focus on the initial rents.
Yeah. It feels like surge pricing a little bit, right?
It's a little bit like surge pricing, but it's also fill it up. People won't move their stuff.
Right, for sure. Because it's sticky.
Once you've, and also people don't feel it. They don't really feel it. It's on a credit card. It's on an ACH draft. It's probably more of a hassle to go get your stuff, move it to another. Nobody's going to do it.
Right. So what would be some of the things that really do matter?
Being a nice new facility in the area, because people do move to a nice new facility. Being climate controlled, having cameras, having a lighting system that turns on and off, makes especially the women feel safe going down a second floor hallway. The way we do it, the lights come on and go off as you walk down the hallway. Keeping the facility clean, making sure it's got controlled access, just making it a nice facility. It makes a big difference. And also being in a market that you're not oversaturated. Now, you may say, well, there's 2 other storages in the area that are full. Does it really need a third one? Well, if the third one is going to be brand new Generation 5 beautiful facility and the other 2 are roll-up door, no climate control, built in 1980, yeah, you can build one there.
For sure. And the facilities that your firm is constructing also often have things like high door bays for things like RVs.
Yes, we have high door bays. We've constructed facilities in hot climates where we can air condition, parentheses, but you can back your truck in and close the roll-up door and unload in air-conditioned space. Now, granted, it's not going to be 68 degrees, but because of the roll-up doors and all of that, but in Vegas, it won't be 121 either.
Right, exactly. Which, believe it or not, sometimes small things like that can be the actual difference in what the buyer decides that they want to pick,
Absolutely.
which modern conveniences are just the same as they are in new construction for single family homes. Internet ability. So you have the ability actually to connect to the Wi-Fi when you get in the building. You have the ability to not have to have someone there at the facility to let you in. Like, we've all driven by the mom and pop storage facility that has no security, that has no advertising, that has absolutely
No
nothing other
cameras.
than
We've
just
got
some
cameras in the one we just completed in Owens in Vegas. To Russ's credit, Russ had built North American Self Storage, and then he founded Your Space America, and I came in as the finance partner, and I'm the second largest shareholder. One of the things we did is we made everything clean, everything's polished, but then there is lighting and camera at every corner. There is nothing missed.
And just to give people a sense of from the profitability of this particular asset class, how many people actually work for the storage facility on a day in and day out basis?
Initially during lease up, so we don't brand them with our name. We do branding deals or licensing agreements. We give up a few percent of the gross revenue, which is minimal, and we do deals primarily with Public Storage, a little bit with CubeSmart and Extra Space, but primarily right now we're with Public Storage because it gives us their national reservation network. If you're moving from Dubuque, Iowa, from a Public Storage to Southern California, you may go Public Storage to Public Storage. One of the top Google searches on the web. We do our own search optimization for each location, but you got the national network. Mm-hmm. And during lease up, you may have 4 or 5 people working there. Once it's stabilized, you may have one. Which is one of the reasons why it is a reason that sometimes storage is hard to get approved in certain municipalities because they're looking for job creation.
Sure.
And storage does not create jobs.
Sure. Understood.
Very minimal on the job. However, we make our facilities look good. We just got approved in Henderson, Nevada, right next to a gas station in the subdivision. But the storage building is going to look like a nice office building or apartment complex. It's not going to look like a storage building.
Absolutely. Absolutely. It's such a fascinating topic. Arthur, seriously, I could spend another half an hour of time here working through the nuance of this particular asset class, but let's just net it out. I'm going to ask you 2 questions. One, as a fiduciary, as somebody who's responsible for other people's money, we have a tremendous responsibility to those people. So we don't take that lightly. If an operator on this show ever behaves as though they take it lightly, that'll be incredibly obvious because most of the operators that we talk to, it's the single most important thing to them. So if Stuart had $500,000 that he wanted to wire you tomorrow, how would you deploy it?
We'd have to know a little bit more about Stuart.
Sure.
But I would probably put, if he's younger, under 50, I'd probably go $300,000 in a storage development for the capital appreciation. And then I'd probably put a couple $100,000 in other things, whether it's notes, whether it's short-term rental, whether it's a long-term rental. If he's younger than 50, I might go a higher percentage into the development asset class. There is a little more risk in development, although very minimal in storage. There is a little more risk in development, but the capital appreciation is better in the development. So the younger, the more I would put into that. If they're already retired in their 60s, well, maybe I put a little less, 150 or so. But it really becomes a balance of where Stuart is. If Stuart is 45 years old, earning a good 6-figure salary, a couple $100,000 a year, everything else in life is stable, then I might go a little higher into the storage, maybe 350, and then just do one rental or something along those lines.
Yeah, which makes perfect sense. Let's cover the elephant. So people know about the short-term rental loophole and how that can be offset against W-2 taxes, and everybody's running around trying to buy an Airbnb, and whether or not that's ultimately going to work out for them remains to be seen, but they have been exposed to the possibility of the tax burden relief that the legislation written created. How does self-storage compare to that? in that particular crucible?
Self-storage does very well in that because so much of the building is on shorter depreciation. My friend Jeff Hyatt is great at doing cost segregation studies.
Shout out, Jeff.
Accelerated 179s on rehab costs, but you can do the cost segregation immediately on Owens in Las Vegas, which we just finished. It's going to be a little greater than 50%.
Nice.
So on a $100,000 investment, you'll wind up with about 50% year one or year of completion. So when you get the CO and you're in service, once your building is technically in service, you can do the cost segregation study, and we're looking at about 50 cents on the dollar. There's some things we may do in some future projects that'll get that greater, and it would be greater in a rehab project or an adaptive reuse where you go into a building and basically everything can be cost segged in an adaptive reuse.
Right.
We're working on a couple of adaptive reuses. You can take an old Walmart, Kmart, and turn it into self-storage. But in this particular case, you're looking at about 50%.
So let's break this one down even further. So I'm going to buy a short-term rental. I got to pick the market myself. I got to go find the product myself. I have to figure out how to create a value add for the guest by myself. I have to manage that or hire someone and share in the proceeds of what we're created, even if we're successful versus what in self-storage essentially.
Well, in self-storage, you're going to go in with the operator. You're not really going to have to do anything. It's going to be quite a passive investment as an LP so that you really don't have to do anything other than put in money, participate in some investor meetings and calls, watch the asset grow, and you'll get your tax deduction.
So for those of you out there that are responsible for enterprise level clients who don't have time to even spend with your children, this is not going to be another burden for you. Yeah?
No, not at all.
Exactly. And there are lots of gurus out there who are trying to convince everybody that short-term rentals are the way to go. And I'm not against it. We're short-term rental people ourselves. We have, obviously a big part of what we're doing in our own portfolio is predicated on that tax loophole, but it's not the only asset class that people can realize this benefit. So thank you for being able to share that with folks.
Absolutely. And I'm investing in a short-term rental with you, and I have some short-term rentals along the coast. So I'm familiar with it. I have no problem with them. Of course, most of the short-term rentals I have are places I want to go anyway, and I rent them when I'm not there. So I'm not in the business just to make money, but I take advantage of it. But I'm in multiple things. I'm in manufacturing. I'm in a glass company. I'm in the mining business. I'm in various industries across everything. I'm in a medical telemedicine company. I invest in a lot of different things, some more active and some more passive. But I prefer investing in people, in products, and in manufacturing, and in things I can control in the stock market. For a percentage of net worth, I have very little in the stock market. I have some, and that might be a large number for some people, but for percentage of net worth, it's a tiny number. But I've always done better with my own things and things I control and are a part of. I'm just not the most passive investor.
And it has a way of working out that way. So even for folks who start passive, they get excited. My wife, Melissa, is a classic example of this. Once she sort of saw the path, she grabbed it with both hands and realized wow, this is more fun than scrolling Instagram mindlessly. We can actually do something to improve our financial future with just a little bit more education and exposure to things. So from a capital shift perspective, Arthur, we know Stuart. We've talked to Stuart. We've talked about Stuart. You have any final thoughts for our watchers and listeners when it comes to this evolution that they might be going through?
I think that they have to understand that if they're working in a tech job, and I'm no tech expert, but things rapidly change. And though there may be always something that's going to pay you a lot of money, maybe there's not. And instead of just gambling on the stock market, maybe you ought to gamble on yourself a little bit and start investing in development deals, self-storage, owning your own properties, rentals, businesses, whatever. You've got to start doing things to bring in money passively and bring in other active income. Don't count on one source of income.
Amen. It's a different kind of diversification, but it's actually more impactful. Arthur, that's it. That's all. That's everything, man. I really appreciate you taking the time and sharing all your knowledge with the folks out there. Thanks again. And I'm guessing we might see you again on this program, sir.
Probably so.
Thanks a lot. There you have it. Like, share, subscribe. Let's get the Capital Shift podcast up at the top of Apple and Spotify. Until next time, this is Roger signing out.